Hello and welcome to this video where we will be covering Chapter 1. We're going to get a basic understanding of managerial accounting. And I'm going to do my best to talk about this from the perspective of someone who knows something about accounting, maybe very little. I know that some of you may know a lot about accounting, some of you may not know as much. So I'm going to try to keep that in mind as we progress through. So first we're going to define, let me go back. We're going to define managerial accounting, explain why it's important, how we use it, and differentiate managerial accounting from financial accounting. So let me just start by saying that accounting is a system that identifies, records, and communicates information in a way so that it is relevant, reliable, and comparable. We're trying to help people make decisions. So when it comes to financial accounting, we're looking at things from the perspective of those outside of the company. And we're trying to give them information so that they can make decisions on whether or not they're going to invest in the company, loan the company money, so on and so forth. Well, for managerial accounting, we're providing information to those inside of the company, managers, human resources, other employees who may need to make decisions about what's going on in the future. So we need accounting information because the individuals who are in the open market trying to make decisions as to whether or not they should buy a certain type of equipment or whether or not they should loan this company money or whether or not they should invest in a company. They need good information. So the primary purpose of accounting is to provide information to the users. We just want to make sure that it is good information. But the primary difference between financial and managerial accounting is who we're providing the information to. Financial accounting, those outside of the company. Managerial accounting, those inside. So when we're looking at financial accounting, things are a lot more formal. There are rules that we need to follow. There's not a lot of flexibility for presenting things one way versus the other because we need, or the users of the financial statements need comparability. They need to be able to look at the financial statements of one company and compare it to the financial statements of another company. So the information that is being provided to the users is pretty consistent. And it's these four financial statements that you see on the screen here. So we have the income statement. The income statement reports on revenues and expenses over a period of time. Revenues are amounts earned by the company. Expenses are the amounts that the company has spent that will help them generate revenue. So we can usually pair revenues and expenses together. The next statement that is prepared is the statement of stockholders' equity. So when we're talking about equity, we're talking about what the owners truly own of a corporation or a business. So on the statement of stockholders' equity, we're summarizing changes in equity. So we'll start with beginning equity, and then we'll add in any profits. So when we're looking at the income statement will yes, report on revenues and expenses, but at the end, it is going to give us a profit amount or net income. So we're going to take the difference between revenues and expenses. Well, that number then rolls forward to the next statement because the owners own those profits. So we take the beginning equity, we add in any profits, and we subtract out any payments or distributions to owners. We call those dividends. And then that gives us our ending equity. The next statement we prepare is the balance sheet. The balance sheet reports on information at one point in time. So it's just a snapshot, just a picture of the financial position of the company. It is based on the accounting equation. And the accounting equation says that assets equal liabilities plus equity. Assets are resources that the business owns or controls. Things like land, cash, equipment, buildings. Liabilities are amounts owed by the company. So we have things like bonds payable, notes payable, when we borrow money from the bank, things of that nature. And then, of course, I've already told you what equity is. Equity is the owners, how much they truly own of the business. So what a business has in terms of assets, should be equal to what the business owes or the creditor's claims on those assets, plus what the owners truly own of the business. So we have to keep in mind that we're separating the owners from the actual business. The last statement that is to be prepared is this statement of cash flows, because in accounting, we use something known as accrual basis accounting. In other words, everything is not cash driven. We could have some revenues, but never actually physically receive the cash in hand. We could have expenses where we actually don't pay out cash to anyone. So when we look at the income statement, a lot of those amounts are not true cash figures. But here's the problem with that. You can have all the net income in the world on the income statement. But if you don't have enough physical cash on hand to be able to pay your employees, pay your bills, you will not be in business very long. So this statement of cash flows reports on cash coming in, cash going out. So that's generally what we're going to see when we're looking at things from a financial accounting perspective. Now, from a managerial accounting perspective, the types of reports that we could possibly see, well, the options are endless because it's all based on what the managers need. We may be trying to help a manager determine whether or not they should add a new product line, whether or not they should close a store, whether or not they should make a raw material or buy it from another company that and let them do the work of making it. We're going to provide information to support managers in making that decision in managerial accounting. We're also going to help managers make decisions on their day-to-day activities and not just helping them make those decisions, providing data to see whether or not it was a good decision. What should we do going forward? So the emphasis is really at the company level, looking at their organizational goals and helping the company achieve those goals. So not a lot of rules. We're forward looking, whereas financial accounting, tons of rules, and we're always looking backwards in terms of reporting on the information or the accomplishments of a company from a previous period. So this slide here does an excellent job of summarizing what I just told you in terms of financial accounting and managerial accounting. We know that financial accounting, we're focusing on those outside, managerial, those inside. And with financial accounting, we're going to see the financial statements prepared in accordance with the rules. Those rules are called generally accepted accounting principles, or GAAP. With managerial accounting, we're going to have tons of different reports that don't necessarily conform to a bunch of rules because it's based on what managers need. And different managers in different departments need different types of information. So how do those reports really differ? And again, some of this stuff I've already said with financial accounting, we're backwards looking, covering a long period of time. Whereas managerial accounting, a lot of times we may be not just forward looking, it may cover a shorter period of time. It's just based on what the managers need. Financial accounting always shows the results of past decisions, whereas managerial accounting, those reports are forward looking, sort of trying to forecast and predict what's going on in the future. Financial accounting, we have to make sure that the information is useful to the users, and useful information is relevant, meaning it's going to make a difference in the decisions of those using the financial statements. It's going to be reliable, so those are going to be good numbers, not just a bunch of estimates that somebody made up and we have no evidence to support that those are really good numbers. And they need to be comparable, which is why we have all of those rules to make sure that the users can compare one company to another company. Whereas in managerial accounting, there may be a ton of estimates. We may not have a lot of information that says, hey, this number is based on what has actually happened, because we're forward looking. So the information is more relevant to the decisions at hand. Now, just like in financial accounting, we have CPAs, certified public accountants, that are generally, I don't want to say governed, but supported by the American Institute of Certified Public Accountants, the AICPA. For managerial accounting, we have CMAs, those certified management accountants. They still need to take an exam, they still need to complete continuing professional education, and they're still subject to the rules of the IMA, the Institute of Management Accountants. So if you're working in private practice, working for a private company and not in public accounting, then you would fall into the category of a certified management accountant. Now, let's take a look at learning objective 2. Now, let's really focus on managerial accounting and see how it supports and reinforces the missions, goals, and strategies of an organization. So, just so that you understand what we're talking about, I know that you all know what a mission is at this point. You've probably written a bunch of missions and actually analyzed missions of other companies as you've been progressing through your program. But it really is the overall purpose of a company's activities. What are they in business for? What's the overall mission? It's really high level. Now, a goal is different from a mission in that with a mission, there is no target that you can actually measure. And sometimes it's not as defined as we accountants would like. But with goals, there is usually a measurable target or a definable target. So you see some examples of goals listed there. I'm sure you've heard about SMART goals where they need to be specific, they need to be measurable, they need to be time bound, all of those things that are involved in making and creating good goals. So, of course, the mission and the goals work together to present a unifying purpose. The goals, of course, are guided by the mission, and the mission directs the overall activities of the company as a whole. The strategy is the how. So, once I know what I'm going to do and I know I can measure, I know what I want to do, and I have a specific target and how I can measure that target, how will I go about achieving that target? Well, managerial accounting, this is where managerial accounting comes in because it really does inform that selection strategy. And we're going to, that selection decision, excuse me, we're going to, in a video in the future, look at in detail 3 specific strategies that are related to managerial accounting that will help organizations achieve their goals. Now, whether we're looking at a for-profit or a not-for-profit organization, all of this stuff still applies. Yes, for a for-profit organization, the primary purpose of any business is to make a profit. For a nonprofit, it's mission driven. So there is some other person or some not person, it shouldn't be a person, some other purpose is what I wanted to say, some other purpose that actually does drive the activities of the business. Now, it doesn't mean that a non-for-profit or not-for-profit entity can't make profits. Yes, they can make profits. It's just that those profits need to be reinvested towards the primary purpose of the organization as a whole. So you still need managerial accounting where you're dealing with for-profit or not-for-profit. It's all about how we're using our resources. Now, what you see on the slide here are the 3 strategies that we'll talk about a little bit more in another video later on, but I'll mention them briefly here. But there's 3 strategies that we'll find in managerial accounting that give us the how we plan on achieving the goals. And those are cost leadership, product differentiation, if I can say it, differentiation, and market niche. So we're talking about cost leadership. The focus is on keeping costs low, reducing our costs as much as we possibly can so that we can increase our profits. Or it could be, yes, keeping our costs low, but we also engage in price competition. So we are willing to increase and decrease our prices based on what our competitors are doing, again, so that we can achieve higher profits. So with cost leadership, it's not about providing the best product, it's really about controlling our costs. With product and service differentiation, we are looking at quality. So we're focused on our product, and our product is special And it usually comes with a premium price. So, yes, we don't want our costs to be completely out of control, but that's not our primary purpose. Our primary purpose is to have this wonderful product that everybody knows about, everybody loves, and everybody wants, and we can charge essentially what we want to for that because people are willing to pay for it. So, with product and service differentiation, sometimes you can put Apple into that particular category because when it comes to Apple, it typically has a cult following, Apple products, and the prices are at a premium, but because it's such a high quality product, everyone wants it. Now, with a market niche, if you're looking at some of your high-end quality cars like Lamborghini, they're focused on individuals who are able to afford Lamborghinis. When you think of the price of a car such as that, that is a specialized market. So they are looking at market niche as their strategic position. Now, managerial accounting helps with all of these strategies through the process of budgeting, analyzing costs, and providing performance reports. Now, with these performance reports, they help us determine whether or not the goals have been achieved and they inform the decisions going forward. So it really is a looping mechanism. We start with, okay, this is my budget based on some research that we did. If we're encountering a new endeavor, this is what I did before. And then I go through my cost analysis, and then I'm looking at my results where I compare the budget to the actual cost analyses, and that will inform my decision going forward. So here I have my budget. Then through cost analysis, I have my actual costs. And then through those frequent and detailed performance reports, we calculate our variant or our deviation from the budget. So we're always happy when we spend less than what we planned on spending. So we call those favorable. And then we see the percentage of that favorability. So here's an organization chart. I'm sure you know what an organization chart is. It essentially tells us who's in charge of what in a particular organization so that individuals know who to report to from a managerial accounting perspective. This is important because we need to know who we're providing what types of information to. Because believe you me, the treasurer is going to need different information from the store manager on the east side. Now, in terms of the activities of management engages in this cycle of planning, organizing and leading, and control. And we assist, we saw that in the previous slide, because for managerial accounting, the planning is budgeting. The organizing is the actual cost analysis, and then the controlling would be those performance reports that would then inform the decisions for that next cycle. All right, that takes care of pretty much the first half of this chapter. Join me in the next video where we'll finish out this chapter by looking at the value chain, and we will also discuss ethics. I so appreciate your time and attention, and I hope you have a wonderful day.